The biggest risk to the global economy isn't in the headlines. It's not war, it's not crypto, not even US debt, at least not the way you've been told. It's something silent, technical, almost invisible, and exactly because of that, extremely dangerous. If you've ever wondered why interest rates don't really fall, why credit is still expensive, or why markets seem to freeze for no apparent reason, the answer starts far from here. It starts in Tokyo. Back in 1992, Japan watched its economy collapse. The largest real estate bubble in history burst. Markets crashed, companies failed, and the country entered what would later be called the lost decades. Nearly 30 years of weak growth, low inflation, and an economy that felt stuck in time. The Bank of Japan responded the only way it knew how, by cutting interest rates. First to zero, then below zero. And when that still wasn't enough, they went even further. They began directly controlling long-term interest rates, forcing them to stay low regardless of market conditions. In practical terms, the government told the market, rates will stay low. Period. The result was simple. Investing in Japanese government bonds became almost pointless. And that's when something bigger began. A system that most people have never heard of, but one that quietly helped shape the global economy for decades. The yen carry trade. Here's how it works. You borrow money in Japan at near zero cost. You convert that money into dollars, and then you invest in assets that yield 4, 5, sometimes even more %. You keep the difference. Simple, predictable, extremely profitable. And for decades, trillions of dollars moved through this system. Japan became the world's largest creditor, one of the biggest buyers of US Treasury bonds, a major source of global liquidity. In many ways, Japan became the world's ATM. But this entire system depended on one fragile assumption, that Japanese interest rates would stay near zero forever. In 2024, that assumption broke. The Bank of Japan changed direction. They raised interest rates. They stepped away from strict control, and they signaled that the era of ultra-cheap money was coming to an end. Markets reacted immediately. Stocks dropped. The S&P 500 pulled back. Japan's own Nikkei index plunged sharply. But that reaction was just the surface. Because when interest rates in Japan rise, two things happen at the same time. Borrowing in yen becomes more expensive, and hedging currency risk becomes more expensive. Suddenly, that easy, reliable profit disappears. And when the math changes, the money moves. Or more precisely, it goes back home. This process is called capital repatriation, and it has the potential to reshape global markets. Here's why that matters. Japan wasn't just another investor in global debt markets. It was one of the most consistent and predictable buyers in the world. Always present, always providing demand. Now imagine that buyer stepping back. If that demand weakens, someone else has to fill the gap. And to attract new buyers, yields have to rise. That creates a chain reaction across the entire economy. Stock valuations begin to fall, even when companies are performing well. Mortgage rates remain high, even if central banks try to cut short-term interest rates. Businesses face higher borrowing costs, which means less investment, less hiring, and slower growth. The entire system begins to lose momentum. And yet, almost no one is talking about this, because this story doesn't sell. It's not dramatic. It's not simple. It doesn't fit into a headline. It's technical, slow, easy to ignore. So instead, the narrative you hear is different. That rate cuts will fix everything. That liquidity always comes back. that there will always be buyers for government debt. But what if there aren't? What if one of the largest structural buyers in the world decides to step back? Liquidity is the oxygen of financial markets, and when that oxygen starts to thin, everything changes. Money becomes more expensive. Growth slows. Risk increases. Not all at once, but gradually, and then suddenly. Markets don't collapse because of obvious threats. Those are already priced in. They collapse because of what no one is watching. The slow shifts, the technical changes, the quiet decisions happening behind the scenes. And right now, one of those shifts is already in motion. Silent, unnoticed, but potentially powerful enough to change everything.